the Elliott Wave model of financial markets might seem intimidating, but I think you'll find that if you take a look, its core concepts can be understood even by a child. So today we're going to introduce you to Elliott Wave analysis at 3 levels. We'll start with a 9-year-old and then move on to a college student and finish with an expert. So if you've been curious about exactly what Elliott Waves are and how they can help you to get an edge in the markets, then come on board to discover a way of looking at the market that's totally different from what most people are used to, but it's an approach that's packed with helpful insights that you can use to understand markets better than even most professional traders out there. So let's get started. Hey Seth, I'm Matt. Nice to meet you. How you doing?
Good.
Awesome, me too. Now today we're going to talk about financial markets. Have you heard of the stock market before?
Kind of.
Kind of? Awesome. Well, we're going to talk all about financial markets, particularly the Elliott Wave model of financial market price fluctuation. That's kind of a big mouthful. But we're going to break it all down, and it's really, at its core, about patterns. Now, Seth, have you seen a pattern before?
Yes.
Of course you have, right? What's an example of a pattern that you've seen?
Like square, square, triangle, triangle, square, square, triangle, triangle.
That's perfect, right? Just some repeating shapes, yeah, all in a row. And what's cool about patterns is that if you can recognize a pattern, then you know what comes next. Yeah, you can predict. So we're going to take a look at some patterns together. Are you up for that?
Yes.
All right, let's get the big board in here and take a look. Okay, Seth, let's take a look at a pattern here. And this is pretty familiar because it's kind of like the pattern that you talked about earlier. So we've got a series of shapes. Now, what's this first shape here?
A square.
Of course, and it's followed by a?
Circle.
All right, now let's take a look at this second line here. Looks quite a bit like the first. We've got a square, then a circle, then a square, then a circle, and then there are 2 shapes that are missing. So if you'd like, I'm going to hand this iPad to you, Seth, and have you draw in the shapes that come next in this pattern. Go for it. All right, we've got a square and then a circle. All right, let's see if you got it right. Okay, Seth, can you do a little drum roll on your pants there? Perfect. All right, here we go. And the correct answer is a square and a circle. You nailed it. Now, Seth, how did you know that the next items were a square and a circle?
Because every single pattern is a square and then a circle. Square and circle. Square, circle.
Yeah, and once you identify that pattern, then you know what comes next. You can predict. So patterns can lead to predictability, just like that prediction you made there. All right, let's take a look at a different kind of pattern. So here we have a series of numbers and then a series of letters. On the bottom, again, we've got a pattern. We've got 1, 2, 3, 4, but we've got some missing items yet again. So Seth, I'm going to ask you to take the iPad back and fill in those missing items. Got a 5, then A, B, and C. Awesome. Well, thank you very much, Seth. Now, you wrote that out pretty quickly. You pretty confident with your answer here?
Yes.
Okay, and you should be, doggone it. Well, I tell you what, Seth, we can make this a little bit more interesting. In financial markets, people invest. And if they're right, they have a chance to make some money. Now, we don't have any money for you to invest today, Seth, but we've got something that might be even better. Would you like to know what it is?
Yes.
Okay. Do you know what this is?
A peep.
This is a peep. Now, I understand you like these. Yeah? Awesome. Well, Seth, this is yours. We don't want to eat it just yet. Hang on to it. Here's the deal, Seth. If you want, you can invest that peep. Now, financial markets always involve risk, so if you've gotten this wrong, you're going to lose your peep. But if you get it right, you get an additional peep. So what would you like to do, Seth? You want to take a risk?
Yes.
Awesome, let's do it. All right, so you say that the next item in this sequence is a 5 followed by an A, a B, and a C. All right, the stakes are pretty high. Let's see, what do we have? A 5 followed by an A, a B, and a C. So Seth, if you have a pattern, you can predict. And if you can predict, well, you've got a chance to make some profit. So hold on to that profit right now. I think we need to raise the stakes. You are doing great, right? This is kind of easy.
Yeah, and I saw that this up here was just the same thing and this same thing.
Absolutely. You saw the pattern, you knew it repeated, and so you knew what came next. Let's do one that's a little harder, all right? Now, Seth, this is an idealized version of a financial market price chart, okay? So we see prices going up, prices going down, up, down, and so on. Now, Seth, if I told you that the pattern we just saw, that 1, 2, 3, 4, 5, ABC, was actually depicted on this screen somehow, any idea how we might do that? It's kind of tricky, right?
Yeah.
Okay, well, let me give you a hint, okay? What if I told you that this first wave up was 1, this second wave down was 2. You kind of picking up on how this goes?
Yes.
All right, I tell you, why don't you put your peeps down there? I'm going to give the iPad to you. Where would 3 go? All right, you've put 3 there. I think you've got the hang of this, Seth, so let's really raise the stakes. You've got 2 peeps, but if you're able to label the rest of this chart, you can have an entire box of peeps. Sound pretty good?
Yes.
All right, let's take the risk. What comes after the 3? 4, and after 4 comes 5 up there, and then what came after the 1, 2, 3, 4, 5? We had an A followed by a B followed by a C. Seth, that is exactly right. Now, before I give these to you, let's wrap things up. What have you learned today about patterns?
That they have to be in order, like by, and it's kind of hard to get sometimes if it's like this.
Yeah, patterns can be tricky, but if you're able to work it out and figure out what the pattern is, then you can predict as you've done here. And if you can predict, then you've got a chance to make some profit. So these profits are yours. Enjoy them. You're welcome to take a bite of a peep if you want. And believe it or not, we just learned the basic building block of every financial market price pattern on the planet. We'll explain when we meet Danielle, a college student, in our next segment. All right, so you got to take a bite of one of those. My goodness, they look so delicious. Just sitting there. Ooh, yeah, how does that taste? Pretty good? Oh man, I wish I had a market to invest in so I could get one of those. Hey Danielle, I'm Matt.
Hi, nice to meet you.
Nice to meet you. I understand you're a college student?
Yes.
Perfect. What year are you?
I'm a freshman.
Freshman in college. Now, do you have a major picked out? Or are you still deciding?
I'm currently an early childhood education major, but that may change.
Absolutely. Well, we're going to do a little bit of education, a little bit of teaching today. Hopefully we'll have a little bit of fun along the way as well.
All right.
Now, do you have some sort of interest in financial markets?
Honestly, I haven't really thought about it.
Yeah, okay, but you've heard of the stock market
Yes.
before. Yes, okay. You know, there's this big exchange in New York where people trade stocks.
Yes.
All right, great. Now, when it comes to prices in the stock market, why do you think prices might go up and down? Any idea?
Things change, so some things become worth more or less, I'm assuming.
Yeah. And that's pretty close to the conventional view of financial markets. I mean, people have all sorts of ideas about why prices might fluctuate. And the argument that we found that's the most consistent with the data is that financial market prices pretty much march to the beat of their own drum. They do their own thing. They have their own rhythm, their own pattern. And we think we know what that pattern is. So if you're up for it, we'll get the big board in here and take a look at it. Sound good?
Sounds good.
So this is an idealized picture of a financial market. So we see prices going up, then down, then up, and so on. And they go up and down in a particular way. They move up and down in 5 what we call waves that make net progress in one direction, in this case up, followed by 3 waves labeled A, B, C that make net progress in the opposite direction, down in this case. And this is an Elliott wave. It was discovered by an analyst named Elliot in the 1930s. And one of the things that's kind of cool about it is that this pattern repeats. So even though we haven't drawn it on the screen, after this 5-wave advance and 3-wave correction, we'd have another 5-wave advance right after it. So let's take a look at that, shall we?
Okay.
So here we've taken the same pattern that we saw before, and we've just repeated it a few times. So if we were to start down here, for instance, we would have our wave 1, that's the first wave up. That would be followed by wave 2. Then we move up in wave 3. And Danielle, your handwriting is probably a little bit better than mine, so I'm going to hand the iPad over to you and ask you to label the rest of this chart. So we had wave 3, so next would come wave 4, perfect, followed by wave 5, and then after that 5-wave advance, we get our 3-wave correction. You're doing great. An A, B, and a C. Then after that 3-wave correction, exactly, that pattern just repeats all over again. So we've got our waves 1, 2, 3, 4, and 5 up, followed by that 3-wave correction, which you're labeling now. Brilliant, A, B, C. And we've got one more leg up here. 1, 2, 3, 4, and 5. Brilliant. Okay, perfectly done, Danielle. So we've got some 5-wave advances. We've got our 3-wave corrections. And if we were to look at this, how many 5-wave advances do you see on the screen?
So would it be 3?
3, right? Because we've got this one here, then we've got this one after it, and then finally, this final 5-wave advance here. Now, what if I were to tell you there's actually a 4th one? You see any way we might fit a 4th 5-wave advance in here?
Can I have a hint?
I can give you a hint, absolutely. So what if I were to say that this first 5-wave advance forms wave 1 at the next larger degree, that 3-wave correction forms wave 2. Are you picking up on a pattern here?
Yes.
All right, so where would wave 3 go?
So 3 would be up here.
Absolutely, after that next 5-wave advance, that collectively would form wave 3, followed by wave 4, which would go
Here.
there. Awesome, and I'll have you draw wave 5 because that's the most exciting wave. Where would that 5th wave go? Perfect, that is wonderful. So you see we've got a 5-wave advance at a larger degree. And why don't you connect some dots for us? Why don't we draw a big wave 1, a big wave 2, a big wave 3, and so on. Perfect. 3, 4, and 5. Brilliant. So if we were to make a forecast for this market, we've had our big 5-wave advance. So what came after the 5-wave advance?
A, B, and C.
That ABC correction, that 3-wave correction. So we don't have to draw the whole thing, but let's just draw an arrow in the direction that you would expect prices to go next. Okay, brilliant. I'll take that back from you. So it's one thing, Danielle, to label basically a textbook version of the model on this chart. And we can point out a couple of nuances here. For example, you'll notice that wave 3 is a little bit longer. And the reason for that is one of Elliott's rules is that of waves 1, 3, and 5, wave 3 cannot be the shortest. So we've depicted that there. And you've seen that this small pattern compounds on itself, or it iterates to form the same pattern at a larger degree of trend. That's called a fractal, all right? So now let's take a step into the real world and look at some real financial market price data and see if we can find the same pattern there. You ready?
All right. Yep.
Okay. This is a chart of the oil market from 1999 to 2008. And it might look a little daunting, a little intimidating, but I think if you get started, you'll start to see a familiar pattern here. So I'm going to hand the iPad over to you, Danielle, and ask if you would please label some Elliott waves on this chart. So we'll start at the beginning with wave 1, perfect.
So then wave 2.
Then wave 2 comes next, absolutely. Now remember what we said, wave 3 cannot be the shortest wave of waves 1, 3, and 5. So where might wave 3 go?
Go up here.
Up here, yeah, it would go at that peak there. And then the correction for wave 4, perfect. And then that final move gives us a 5th wave up there. Okay. And this is becoming old hat at this point, but after that 5-wave advance comes the
Correction of A, B, and C.
Comes that correction. So again, let's just draw an arrow in the direction that we expect the prices to go next. Okay, so we're looking for a pretty substantial move down here after this 5-wave advance. Perfect. Well, I'll take that iPad from you. And Danielle, this was an interesting time in the oil market because around this time, there were all kinds of experts and analysts and authors who were making an argument that the world is running out of oil. And because something's becoming more scarce from a supply and demand perspective, what's left of it becomes more valuable, right? So they were saying that oil prices would continue to go even higher. In fact, we can look at just some of the books that were published around this time calling for ever higher prices because of this scarcity argument, running out of oil. We see some of the titles, Beyond Oil, Twilight in the Desert, Out of Gas, How You Can Thrive When Oil Costs $200 a barrel at the time it was trading in the 140s. So this is a pretty different outlook. These people are looking for prices to go to the moon, whereas if we revisit your forecast, Danielle, you're expecting the total opposite. You're expecting a pretty dramatic move down in the oil market. So the choice is yours, Danielle. You can go with the consensus or you can stick with the waves. Which would you like to do?
Let's stick with the waves.
We're going to stick with the waves? Absolutely. Let's do it. Let's see what came next. There was a crushing move down in the price of oil. This is a 78% drop in 5 months.
Wow.
And it caught all of those authors, all of those analysts, all of those experts off guard, but not you, Danielle, because you stuck with the waves. All right, now, of course, not every market is this clear or offers this sort of an opportunity, but just the fact that you can make a forecast like this with the Elliott Wave model that's at odds with the consensus, but can spot a move like that, it's kind of cool, right?
Yeah.
All right, so what have we learned today about financial markets and Elliott waves?
Well, if you look at a graph like this, you can predict what could possibly happen in the future.
Absolutely, yeah. You know this pattern of financial market prices, and if you can spot the pattern and you know where you are within it, then you've got a shot at seeing around the corner and making some pretty cool forecasts. Brian, thank you so much for coming in and speaking with us today.
Happy to be here.
Now, you are an expert Elliotician. How did you come to the wave model? How did you find out about it? What was it that attracted you to it?
Yeah, it initially caught my interest just because it was unlike anything I had ever used before in my trading or investing. And then I think what really kept my attention was the simplicity and the practicality of the model. I'm just a minimalist by nature. I like to keep life simple, and it really kind of fit my personality. And I remember when I first started learning about Elliott waves, I found this old speech of Bob Prechter's, I think it was back in the 80s, and he was walking through some forecasts that he made in the Dow at the time, and it was a seminar, but he was walking through some real-time forecasts that he made. And it wasn't, he didn't come out and say, oh, I'm bullish or I'm bearish. He was actually, saying, okay, prices, if I'm correct, prices should come down to this level, and then they should rally to a minimum level here, and then there'll probably be a setback. And at every point along the way, he's hitting the market by within 1 or 2%. And then at the end of the speech, he said something, I think he was only half joking, where he said, to make these kind of forecasts, all we really need is the ability to count to 5. And that is, that's only half joking. I mean, it does take a lot of time to kind of learn the rules and to learn the guidelines and to incorporate them into your trading. But once you really understand what you're looking at, you can pull open a chart and you can see these patterns without much effort at all. And so it really does, it's not much more difficult at a certain point than counting to 5.
Yeah, and we've seen some examples of that today, in fact. Now, when you think about how you've been able to use the wave model as an analyst or as a trader even, what kind of an edge has it given you? What has it allowed you to do?
Yeah, there's a lot of things to talk about there. I think it might be useful just to kind of talk about my evolution as an analyst and as a trader. I was initially never attracted to fundamental analysis. Some people are. I'm talking sort of the Warren Buffett style value investing. I found it boring. I don't enjoy, looking through financial reports and that kind of thing. So I was immediately attracted to technical analysis, and I devoured all the books. There's a famous one by Edwards and McGee that is kind of the Bible of technical analysis. And I learned, all these chart patterns and momentum and divergences and all these mathematical tools to use. And I still found that I was an absolutely terrible trader. And what I realized was, even though you can look at a market and make a great forecast, once you have your own money on the line, it's like all your analysis just goes out the window, right? And that's the emotional component that wave modeling really helped me with. In a sense, it kind of saves you from yourself, and it forces discipline onto an undisciplined trader. And one of the ways that I love that it helps with that is that you can map out a position before you ever enter that position. You can know specifically, okay, I see a pattern that I recognize and I'm going to trade this pattern, whether it's a daily chart, a weekly chart, an hourly chart. And you can say, okay, here's where I'm going to enter the position. This is what the expected move is going to be, so I can calculate that reward. And this is where I know that I'm wrong. This is where whatever I saw was just not what it was, and I can get out here. So I can calculate a defined risk and a defined reward, and various traders have different ideas on what that multiple should be, but you can map out your entire trade before you ever take on a position. And that, for me at least, and I think a lot of traders go through the same experience, that really forces discipline on you.
Yeah, and that's so important as a trader and also as an analyst as well, to be able to say, okay, here's a key level. We know if we meet this level, then we've got to revisit the forecast.
Exactly.
One of the other things I love about the wave model is that it saves you from the scourge of trend extrapolation.
Right.
We saw an example in the oil market earlier where we've got the whole tide of conventional analysts just extrapolating that trend on and on and on. But with the wave model, you can extrapolate with a fractal and see these big moves coming before just about anybody else.
That's also interesting, is because it's naturally contrarian. When you see a 5-wave move to the upside and you start seeing every analyst on the planet just saying, hey, this is just going to continue, get into this market, that's a clear sign that something is about to reverse.
Now let's talk in a little bit more detail about what the wave model allows you to do that would be pretty tough to do with just about any other method.
Yeah, let's look at some charts.
Sounds good.
Right, so the thing I love most about the wave model is it really helps to contextualize market action. And the context comes from the fact that we have this fractal pattern. We have a basic underlying pattern that is playing out at nearly every degree of trend. And I brought a few charts just to show that. On the left, all I'm looking at here is tick data in the Dow Jones, all right? We're looking at 3 minutes from 3:56 Eastern Standard Time to 3:59 Eastern Standard Time. This happens to be on October 6th, 1997. And you can see the basic pattern. We have a 5-wave advance, and that advance gets corrected with a 3-wave decline. We can take this out as far as we want. We have hourly data here. Every bar represents 1 hour of trading in the Dow. We have the same 5-wave advance and the same 3-wave decline. We can go further with this to daily data. These are daily bars. Every bar represents 1 day of trading. And we have the same 5-wave advance, 3-wave decline, same way with the weekly data. So the thing that is fascinating about Elliott waves is they provide this context, and they take a market that is oftentimes mysterious and seemingly chaotic, and they make markets understandable. And you can look back at weird market data. There was a famous crash in '87. We can look at you showed a chart of oil prices before. You can look at the financial crisis in '08, and you look at these things and you're like, what is going on here? The market is making new all-time highs one day, and the next day in '87, it's down 25%. The financial crisis, over a period of 1 year, market lose half of its value. And the interesting thing is, looking at those moves on a chart is really no different than looking at this daily chart or this weekly chart. All that's going on is the market is tracing out progress, and it's correcting that progress at every degree simultaneously.
And we've seen so many charts of that here, from the tick data all the way up to the hourly to the weekly. I imagine some people are going to want to know, Brian, how far back can we take this? How big can we zoom out?
So that's a great question. And yeah, the question is, if we see this on a 5-minute chart, on a 5-day, 5-hour, 5-week chart, do we also see this on a 5-decade chart or a 5-century chart? And the answer seems to be yes. A colleague of mine, we actually have good stock market data back through 1700s. A colleague of mine took this chart. This is the UK Financial Times All-Share Index. We're going back through the 1700s. And there's a very commonly occurring pattern called a contracting triangle. There's an ideal representation of that up here. All a triangle is doing is it's a pause in the market, right? You have 3-wave moves where the price action kind of contracts in on itself. And we see this all the time on the near-term charts. It's actually a really easy pattern to trade because you can kind of see where this is going to end, and it always results in a thrust up or down out of that pattern. And so we looked at stock market data back through the 1700s, and we have exactly that pattern. This peak here is in 1720. That's the famous South Sea bubble. I think that one even got Isaac Newton caught up in it.
That's right.
And over here, we have basically a 2-century contracting triangle that ended around World War II with the siege of Britain. And so this is one thing that really, I think, validates the wave model. We've got a pattern that we see on near-term basis all the time. We look at historical market data, and we see the same pattern over 2 centuries. And I think that kind of perspective is really quite powerful and completely unique to the wave model.
So today we learned about the Elliott Wave model. We saw a 9-year-old learn the basic 5-3 pattern. We saw a college student use Elliott waves to call a turn in the oil market better than just about every conventional analyst on the planet. And an expert shared with us how Elliott waves allow him to analyze markets unlike any other approach. So now when you see charts of the markets, you might just find yourself counting waves and spotting opportunities that put you ahead of the herd. Happy surfing out there, and I hope you ride the perfect wave. This has been a production of Elliott Wave International, the world's largest independent market forecasting firm, helping readers ride the waves for 40 years and counting.